In this video, you'll be learning about this topic.
So Robert, when somebody is listening to this, they're saying, well, how is Bitcoin actually fixing its supply? We all know there's going to be 21 million coins eventually. How is that actually being fixed?
Yeah, so as I've argued in a lot of my writing, that the monetary property of scarcity has been perfected in Bitcoin. Right? Everything throughout history, the relative scarcity of anything throughout history was just a function of how much time was allocated towards its production, right? But with Bitcoin, which is really interesting, and it hinges on that difficulty adjustment component of the algorithm. So no matter how hard we try, how much energy or time we allocate towards Bitcoin production, the difficulty of the mining puzzle or algorithm adjusts such that it only issues a fixed and predictable supply of Bitcoin, consistent with that asymptotic curve towards 21 million in 2140. And this is, I argue, it's a one-time discovery, right? You cannot replicate an absolutely scarce money. And the reason behind this is it's called path dependence. And this is a bit of a complex topic, but it essentially means that history has inertia. So the order of events which led to an outcome actually has relevance to that outcome. So one example of path dependence would be, the real simple example would be if you shower and then dry yourself off, you get a very different result if you dry yourself off and then shower, right? So the order of events matters to the outcome. A more nuanced example would be if you tried to go and campaign the world, or let's just say the United States, to switch to a different socket of electrical outlet, right? Instead of a 3-prong electrical outlet, say you wanted an 8-prong, you would have to summon, 10x minimum improvement to the marketplace to get people to incur the switching cost, right? So there's been this path of development that led to us having a 3-prong socket that makes it really hard to disrupt, right? It's a protocol, like an internet protocol, that everyone has already adopted and it's become ossified, right? Like HTTP, TCP/IP. And it gives whatever has been adopted and absorbed the network effect a resistance to disruption. And so money in that sense, right? Again, it's a tool for trading value across space and time. So it's always valued based on its liquidity, right? And because trade itself is this singular universal phenomenon, the market tends towards one money, right? That's what gold was. That's what the US dollar is today. And that's what we argue Bitcoin. It's a race that's already been run by Bitcoin, right? It's an order of magnitude more liquid than anything else. And it's got the greatest network effects for money in the crypto asset space. So any new investor that's going to come in and look to allocate a position into a monetary crypto asset will necessarily choose the deepest and most liquid option, right? And so this network effect becomes further self-reinforcing. That's what makes money a winner-take-all market, right? Because the network effect is already established, and any new entrant always wants the most liquid asset in their portfolio. And then we talked earlier about the specific network effects of Bitcoin, how they're multi-sided, that further protects it from disruption. And another way to think about this is that Bitcoin perfected those 5 properties of money, right? There's no attack surface left in the concept of money for a competitive technology to come in and disrupt it, right? How do you make anything more divisible, more durable, more portable, more recognizable, or more scarce than Bitcoin, right? It's perfected these properties of money. So there's no attack surface, if you will, for a competitive crypto asset.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.